When it comes to building wealth and securing your financial future, asset allocation is one of the most important concepts you'll need to understand. It's not just about how much money you have, but how you wisely divide it between different investment types to balance risk and return. Proper asset allocation is key to growing your wealth over time while managing market ups and downs. Whether you're new to investing or looking to refine your strategy, the right asset allocation can help you build a strong, resilient portfolio. In this video, we'll break down the top 5 smart asset allocation strategies for beginners to help you take control of your investment journey. Let's dive in. 1. The 60-40 strategy, stocks/bond split. One of the most common and simple asset allocation strategies is the 60-40 rule. In this strategy, 60% of your portfolio is allocated to stocks equities, while 40% is placed in bonds, fixed income securities. The idea behind this mix is to achieve growth through stocks, while mitigating risk with the stability that bonds provide. Stocks offer higher returns over time, but come with more volatility, while bonds offer lower returns but greater stability. This strategy is ideal for beginners because it strikes a balance between growth and risk, allowing you to gradually build wealth while maintaining a more conservative approach, reducing potential losses. As you get closer to your financial goals, like retirement, you might consider shifting this ratio to be more bond-heavy, reducing risk as you approach your target date. This is especially important because, as you near retirement, you may not have as much time to recover from market downturns. A safer approach helps protect your savings. The key to successful asset allocation is diversification, spreading your investments across different asset classes, such as stocks, bonds, and real estate. Diversification reduces overall portfolio risk and helps ensure steady long-term returns. By rebalancing your portfolio periodically, you can ensure that it remains aligned with your evolving financial situation, goals, and risk tolerance. Rebalancing involves adjusting your investments to maintain your desired allocation, helping you stay on track to meet your long-term objectives while adapting to any life changes or market conditions. 2. The age-based asset allocation strategy. An easy way to approach asset allocation is to base it on your age. This strategy suggests that your asset allocation should gradually become more conservative as you get older. The most common version of this strategy is the 100-age rule, which is simple to calculate and easy to implement. For example, if you're 30 years old, you would allocate 70% of your portfolio to stocks and 30% to bonds. 100 minus 30 is equal to 70. This approach allows you to take on more risk when you're younger, giving your portfolio time to grow through higher-risk assets like stocks, which tend to have better long-term returns. As you age, your portfolio will naturally shift towards safer investments like bonds. This helps protect your savings from market volatility, which can become more concerning as you near major financial milestones like retirement. Bonds tend to provide more stable returns and act as a safeguard against the market's ups and downs. While this strategy isn't perfect for everyone, it offers a good starting point, especially for beginners, by simplifying the decision-making process. The 100-age rule provides a quick, easy framework that doesn't require extensive financial knowledge. Over time, you can adjust your allocations to better reflect your own risk tolerance, financial goals, and personal circumstances. As your financial situation changes, so too should your asset allocation strategy, ensuring it continues to align with your evolving goals. 3. The risk tolerance-based strategy. Another smart approach to asset allocation is to base your strategy on your personal risk tolerance. Everyone has a different level of comfort when it comes to risk, and understanding your own tolerance is essential for making sound investment decisions. Some people are more comfortable with risk and are willing to allocate a larger portion of their portfolio to stocks, while others prefer a more conservative mix, focusing more on safer investments like bonds. The key is to honestly assess how much market volatility you're willing to accept. If you're younger and more risk-tolerant, you might opt for a more aggressive mix, such as 80% stocks and 20% bonds. This strategy focuses on growth through equities, which tend to provide higher returns over the long term, despite their volatility. On the other hand, if you're more risk-averse or nearing retirement, you might prefer a more balanced, conservative portfolio like 50% stocks and 50% bonds, which offers stability while still allowing for some growth. To determine your risk tolerance, consider how you would feel if the market experienced a downturn. Would you panic and sell your assets, or would you remain calm and stick to your strategy? Understanding this emotional response can help you create an allocation that matches your comfort level and financial goals. By aligning your portfolio with your risk tolerance, you're more likely to stay the course during market fluctuations and avoid making emotional decisions that could harm your long-term investment strategy. 4. The Global Diversification Strategy. Global diversification is a strategy that involves spreading your investments across different geographic regions, and it's an effective way to reduce risk in your portfolio. Different countries and regions experience economic cycles at different times, so by investing internationally, you're not solely dependent on the performance of your home country's economy. For example, if the U.S. market is struggling, international markets or emerging economies could be performing better, helping balance the overall performance of your portfolio. This reduces the risk of having all your investments tied to a single country's economic conditions. A diversified global portfolio typically includes a mix of U.S. stocks, international stocks, and emerging market stocks, as well as international bonds. This ensures you're not just focusing on one market, but gaining exposure to various economic growth opportunities around the world. By diversifying globally, you give your portfolio a chance to benefit from different industries and regions that may be growing at different rates, potentially enhancing your overall returns. The goal here is to not put all your eggs in one basket. Global diversification ensures that your portfolio is exposed to a variety of international opportunities, which can increase potential returns and decrease risk. Even if one market or region is underperforming, others might be thriving, which helps maintain a more balanced and resilient portfolio. This strategy is particularly valuable for investors looking to reduce risk while still benefiting from the global economy's growth. 5. The Core Satellite Strategy. The core satellite strategy is a hybrid approach that combines a stable core with higher-risk satellite investments, creating a diversified portfolio that balances risk and reward. The core of your portfolio typically consists of low-cost, broad market index funds or exchange-traded funds, ETFs. These funds provide exposure to the overall market, often tracking major indices like the S&P 500. They are designed to provide long-term growth while minimizing costs and risks, as they invest in a wide range of companies and industries. By focusing on these low-cost funds, the core portion of your portfolio helps to reduce volatility, acting as the foundation for steady growth. The satellite portion of your portfolio consists of higher-risk, more specialized investments. These might include individual stocks, sector-specific funds, or alternative investments like real estate or cryptocurrencies. These satellite investments carry more risk, but also offer the potential for higher returns. For example, investing in emerging technologies or a specific industry might yield significant gains if those sectors perform well, but they also come with increased volatility. This strategy allows you to capture the stability of the core while taking on higher risk opportunities for potential higher returns with the satellite investments. It's ideal for investors who want to keep their portfolio diversified, providing a cushion against market downturns, while still having the flexibility to pursue more aggressive growth strategies. By keeping the core stable and using the satellites for higher growth potential, this approach offers a balanced path to wealth building. It's a strategy that combines the best of both worlds: security from the core and the excitement of growth from the satellites. There you have it, 5 smart asset allocation strategies for beginners. Whether you choose a more traditional approach like the 60-40 rule, or a more personalized strategy based on your risk tolerance or age, the key is to diversify your investments and adjust them over time based on your changing financial goals. If you enjoyed this video, don't forget to give it a thumbs up, share it with your friends, and subscribe for more investment tips and financial strategies. Let us know in the comments which strategy you're most excited to try, or if you have any questions about getting started with asset allocation. I'll see you in the next video.